The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Thank you for participating in today's webinar, 2014 Tax Preparation. My name is Veronica Posada with Physician Partners and Physician Resource Center. Today's presenter is Erica Martinez. Erica holds a master's degree in taxation and finance. Nearly 13 years ago, she found Paragon accountants to help individuals and businesses with their bookkeeping, tax advisement, tax preparation, and accounting needs. Paragon Accountants is located in Bankers Hill near downtown San Diego. Erica, welcome and thank you very much for hosting today's webinar on 2014 tax preparation. It's time to get started.
Thank you, Veronica. I appreciate the introduction. Thank you, everyone, for attending. Hello. So let's get started here. My first slide, sorry about that, just a second, okay. My first slide is a quote that I'm sure most of you are familiar with, which is from Benjamin Franklin. In this world, nothing can be said to be certain except death and taxation. So why is it that most of my clients every year are frantic about tax preparation and closing year end? Well, I think part of that is because they're just not familiar with what is required of them. So hopefully today in today's webinar, I can help ease some of that uncertainty and provide you some tools that you can use within your office to better prepare for each tax season moving forward. So we're going to start with best practices for closing your books. We're going to start with daily tasks that should be used, some monthly tasks, and then annual tasks for the dreaded tax season. Things to do. The daily tasks that I would recommend and advise the majority of my clients within their internal accounting process is monitoring cash balances, including outstanding checks if possible, ensuring that you have adequate cash on hand, and if there are any discrepancies, that you're managing these on a daily basis. Ensuring that all income and expense activities accounted for accurately is crucially important for tax season, considering that you never want to be audited and having to deal with incorrect accounting procedures. So managing those on a daily basis will benefit you in the long run. Monthly tasks that I'd recommend are always reconciling your bank and credit card accounts against the general ledger and your statements. This will ensure accuracy in your books. It will also help you determine if there are any potential issues, that you catch them in a timely fashion. Preparing financial reports, I can't emphasize enough how important that is, and getting approval either from the board members within your organization or the officers within your organization. It keeps the accuracy and attention to detail in the forefront. Reviewing accounts receivable and accounts payable, again, a monthly task that should be done. You never want to leave dollars missing here. Potential mistakes on invoicing or non-payment can really impact your business come tax time. Track all assets bought and sold every month and reconcile those capital assets with detailed listing of major items, meaning maybe some equipment, automobiles. These things are crucial for tax time, again, because there's depreciation impacts on the tax benefit of these particular assets. Moving on, things to do and remember for your annual processes within your offices. Tracking any outstanding checks more than a year old is a great practice to have. There will be many times where I have clients come in and they've either overstated their expenses or understated their expenses because of this particular issue. It could be a potential item where maybe the bookkeeper in your office or yourself, if you're managing your own books, potentially duplicated a check. And maybe it's an $8,000 check. Obviously, that's a gross mistake, but mistakes happen. the key to this point is that looking at these yearly outstanding checks can help eliminate any potential audits or amended tax returns if you find them in a later year, which is a cost saver. Making sure petty cash entries and reimbursement requests have been submitted before the end of the year is another major item that I find a lot of my small businesses seem to forget. When you have petty cash, typically it isn't a substantial amount of money, so many employers don't seem to pay attention to it and could potentially miss some additional expenses that could reduce their tax burden. So make sure that this is on your annual checklist of things to do before you close the year end, or you potentially could be increasing your tax burden and reducing your eligible expenses. Reviewing 1099 miscellaneous vendor list and requesting updated W-9 forms for those eligible vendors is a high ticket issue right now. As you know, we need to get 1099s out to all of those non-employee compensation for services that you've paid out in the current or in 2014 tax year. So by keeping a vendor list and updating those W-9 forms before the close of the year is much more advantageous for you to do while you're still paying potential vendors and they would like those checks before the year end. So you've got their attention before year end closes, and then you're more likely to get those W-9 forms in a timely fashion. Fringe benefits that need to be reported on W-2s. This is another key issue with the health insurance benefit. A lot of small business employers tend to run their own payroll and aren't familiar with some of these guidelines. So I find it very beneficial to keep this in an annual checklist as well, because if you do have shareholders who are getting a W-2 W-2 at the end of each year, their health insurance benefits need to be reported in box 12, as well as any retirement contributions. And that goes along for any employee who you provide those similar benefits to. So please make sure as you're preparing for your W-2s that those types of benefits are in box 7 on the W-2. And if you aren't familiar with these things, please feel free to always check in with us or your CPA, tax preparer, or internal accountant, okay? So basically, we've summed up some of the major things that I recommend, as well as most CPA accounting firms would recommend, that internal procedures happen in your best practice to prepare for the end of the year and ensure the accuracy and that you aren't missing any major expenses that could reduce your tax burden, which is always at the forefront of all employers' minds. All right, we have one more additional item here, which is the reviewing of asset purchases. As I mentioned earlier, your asset purchases could be major equipment, maybe repairs and maintenance or improvements to your office, automobile expense. Those items need to be detailed with not only your date of purchase, the purchase price, the type of asset, the make and model, the year, and whether it was new or used. And these are crucial items to detail out because they impact the depreciation aspect of this expense over the life of the asset. Okay, next we have the balance sheet. Now, for many of you, the balance sheet is something that you're not familiar with. What is it, right? And most of the time you just pass that on, to your CPA or tax professional. But the balance sheet as a business owner is crucial. It tells you the assets that you have on hand, the liabilities that are outstanding, and these things have to be reviewed at a minimum of an annual basis. And again, the reason for that is because you could potentially be missing some crucial operating expenses. In this case of the slide that I've provided you here, managing your retained earnings and matching it with last year's retained earnings ensures the accuracy of your books. The retained earnings account zeroes out at the end of each year. It carries forward all of your net income. This should always match, and it's a good check and balance to, again, confirm the accuracy of your books. Making sure that any line of credit balance as of December 31st matches your lender's bank statement also ensures the accuracy of your books. In many cases, I find when a client comes to me, I look at their balance sheet, and the liability account, whether it be a line of credit or an auto loan, is grossly overstated because their bookkeeper potentially did not itemize the breakdown of those payments between interest expense and principal. When doing something like this and not catching it, the impact is that you have understated your interest deduction in that calendar year. So this is, again, a crucial item to pay attention to and to at least look at on an annual basis so that you are realizing 100% of the interest deduction that you are eligible for. Making all asset depreciation entries and adjustments. In most cases, you aren't doing this internally, but your CPA or tax professional should be providing you a depreciation schedule for all of the assets that you maintain on the balance sheet. Now, this depreciation expense is allowable by the IRS code and determines how much of the asset purchase you're able to expense in the given year. So a posting entry needs to occur as of 12/31 based on the schedule that's provided to you. If you aren't familiar with this, you definitely should be asking your accountant for this information. Taking a physical inventory. Now, this might not be applicable to everybody, but anybody who does sell a good, I recommend this is a crucial thing, again, to do at minimum at least annually, if not more frequently. Inventory valuation is important because inventory purchases are not expensed until they're sold. So in many cases, a client might have obsolete items that they no longer can sell but should expense. In this inventory valuation, you can make those determinations and potentially offset, again, some of your tax burden. Continuing on with the balance sheet, creating a separate equity account on your balance sheet, which is commonly called owner's draw or distribution or shareholder distribution if you're an S Corp, is another key item to do. This is for any expenses that are potentially drawn from the, not expenses, but cash withdrawn from the business that was used for personal expenses by the owner of the business. By creating this line item, it again clearly represents what the owners have taken out of the business each year. If your business accrues payroll or any type of prepaid insurance, you again need to review these line items annually for accuracy so that you're carrying forward the balance on both the liability or asset accounts related to these particular items. And lastly, related to the annual activity that we recommend is to always archive and back up your data. The last thing anyone wants to do is have to recreate their accounting activity for multiple years. It's extremely expensive to request bank statements and cleared checks from your bank, and no one wants to do that. Restricting access, creating passwords for your bookkeeping system, whether it's some particular type of accounting software like Intuit's QuickBooks or any others that are out there, is another great idea for closing your year end. By creating a password and closing out the year allows for people within your office who potentially could be managing the day-to-day activity within that bookkeeping software the inability to change anything for prior years. So it keeps the integrity of the prior year's books and restricts any changes for those years as they've been closed. Meeting, now this one I can't emphasize more, meeting with your accountant before year end will allow you to determine what your target net income should be and discuss the necessary steps that could help you defer a portion of your tax bill. A lot of times clients will come to me after the year closes and have all these great ideas for the business. And unfortunately, since the year is closed, there won't be any major tax benefit for those particular ideas in the current year. So by meeting with your accountant in advance, we can much better help you determine how to defer some of this tax burden before the year closes. So I know it's difficult to get some of your tax, CPAs or tax professionals right come January and end of year. So try to meet with them. We always recommend to our clients, try to schedule an appointment around November. That way you have the majority of your books in order so that they have a true visual perspective of what the net income is at the current time of your meeting, and then they can better plan with you on how to reduce some of that tax burden. All right, now we're going into year-end important deadlines. You should always keep these particular deadlines in the forefront when you're doing your year-end closing. So let's start off with February 2nd. February 2nd is the absolute deadline for the Internal Revenue Service when it comes to furnishing W-2s to employees, furnishing 1099s to your non-employee compensated vendors, and preparing and filing your 940 and 941 payroll returns. Now, some of that might not be applicable to you, but those are the dates that you should definitely be considering and making sure that you're meeting if they are. March 2nd is related to sending the W-2 and W-3 forms to the Social Security Administration Office. This is how we all get our Social Security benefits at some point. So this is a crucial deadline. Sending copy A of the 1099 miscellaneous is for the IRS. So you send a 1099 miscellaneous form to those independent contractors for the non-employee compensation. You also have to send that form to the Internal Revenue Service, and this is their way of auditing individual non-employee compensated services. So both those two items need to be submitted on March 2nd unless you're electronically filing, and in that case you have up to March 31st. The next important date to note is March 15th. March 15th is your corporate tax return filing deadline and your retirement contribution deadline. So if some of you have a simple IRA with your company or a SEP IRA, those will be your deadlines for the contribution for 2014 tax year, unless you file an extension, and in that case, both of those two filing dates will then be extended to September 15th. All right. So next, another important thing to note for 2014 is this Affordable Care Act, which I'm sure you're all aware of and is the big buzzword around the Internal Revenue Service and accounting firms today. And it is important for the small business owner as well, because what does that mean for you? Well, if you're an employer with less than 50 employees, then you aren't required to offer the insurance. So you're exempt. Those with more than 50 employees will be required to pay 60% of the cost for an employee's minimal essential coverage. Now that's, what does that mean, right? Well, that is a minimal essential coverage provided by the feds. And so in most cases, speak to your insurance agent. I'm sure they can give you some detail on that. Now, the insurance coverage, if you choose to provide it, under this new Affordable Care Act, the premiums for each employee cannot exceed, this means their expense out of pocket, cannot exceed 9.5% of that employee's household income. So there's some restrictions here. So even if you provide the insurance, if their premiums that they pay out of pocket exceed the 9.5% of that employee's household income, you no longer qualify under meeting this requirement, okay? So you need to be aware of that number. Now, not all is, negative with this Affordable Care Act. There is some help for the small business owner if you choose to provide the health insurance or are required to provide it. Currently, there's a tax credit available under the Small Business Health Option Program. And this health insurance credit allows up to 50% of the employer's premium contribution as a tax credit, meaning you get it back. And so this is an excellent tax credit that the Internal Revenue Service has provided, and it lasts for 2 years and then gets reduced to 35% of those premiums as a tax credit. So make sure that if you are providing health insurance for your employees, even if you're not required to do so, that you talk to your accountant and make sure that they are aware of this tax credit, and if you're eligible, that you're applying for it, because it is a return on dollars for you. Now, the small business health credit, what are the requirements? How does it work? Well, like I mentioned in the previous slide, currently you get 50% of those premiums as a tax credit for the first 2 years. But how are you eligible? What are the requirements with this? Well, first, you must be a small employer and have fewer than 25 full-time employees. The pay on an average wage for those employees has to be less than $50,000 a year. So if your employees on an average exceed $50,000 a year, unfortunately, this tax credit will not apply to you. And you must also pay at least half of the employee's insurance premiums. So again, this is something that you still should bring up to your tax professional, but they should be asking you these questions and determining whether you qualify. Now, the small business health credit, the form to be filed for this credit is Form 8941. In most cases, you shouldn't have to worry about this, but again, provide this to your tax professional, see if you qualify, and hopefully you do, and you'll get some dollars back. If you're a tax-exempt organization, the form to file for this credit is 990-T. And again, your tax professional should have this information readily available for you. So lastly in our webinar is business tax changes under the Internal Revenue Service codes. There's a few major changes this year in the 2014 tax revenue code passed by Congress, and I've outlined them here for you. So the first one is the standard mileage reimbursement rate. In 2013, the rate per mile was 56.5 cents per mile. In 2014, Congress passed that we're going to reduce that percentage per mile to 56 cents. 2014, Congress had also increased the annual maximum Social Security tax. So this is a payroll tax. And In 2013, the annual maximum Social Security tax was based on a salary of $113,700 per year. In 2014, it's $117,000 a year. I think roughly it impacts the business at a 6.2% of Social Security, probably about a $204 tax burden, additional tax expense for the employer and for the employee. So not majorly big change there, but it is something to account for when you're doing your 2015 budget. Accelerated depreciation. So this is a major item here, and it's a hot topic for all business owners. Historically, the IRS, for several years now, has tried to stimulate the economy back in 2008 and 9, and they created these additional tax benefits, which were called Section 179 and Section 168K, and they're depreciation accelerated benefits. So in 2013, a business could purchase major equipment up to $500,000, and as long as you met certain requirements, could take that particular equipment and expense it in the year it was purchased, which was huge. And it helped many small to medium and even large businesses buy some much needed equipment, maybe some medical equipment, and reap the tax benefit in the current year. Well, unfortunately, those days are gone. 2014, the IRS reduced that tax benefit from $500,000 annually to only $25,000 annually. So this is a big IRS change in the current 2014 tax year, and it's causing quite a bit of additional paperwork for the tax preparer, because we have to change the election of depreciation for those prior years related to this new tax requirement that Congress just passed. Similarly to Section 179, which I was just talking about, there was a different depreciation, Section 168K, which didn't have limitations that Section 179 did, and it was called a bonus depreciation. So if a business owner decided to purchase some equipment at, let's say, $200,000, and there were some limitations under the Section 179 depreciation schedule, they could do a bonus depreciation of that asset at 50% in the current year they purchased that asset. In 2014, unfortunately, Congress said no longer. We're not going to allow businesses to take any bonus depreciation. Therefore, now a business will have to depreciate these particular assets over the life of the asset, which is a huge deduction in tax benefits. So these are the four major business changes, the two of which, the Section 179 and Section 168K, are going to have the largest impact on the business owner and the tax burden in the current year, tax year. That pretty much sums up my webinar for today.
Thank you, Erica, very much for that great presentation. I'd like to open this up for Q&A. If you have any questions for Erica, please type them in, and Erica can answer your questions. And it looks like we have some questions that have already been entered in. And one of the questions is Fringe Benefits. I hear gifts up to $600 does not need to be reported, like a Christmas gift card, etc., to employees. What if I pay a certain amount to the employee to help them with insurance? Okay, I have less than 5 employees. Okay, so we'll go with the first question first for Erica.
Okay, so this is Mary, I believe, who's asking this question. Fringe benefits, okay. So I think what you're talking about, this $600 number, has to do with the 1099 non-employee compensation IRS requirement, right? So if you pay somebody under $600, technically you're not required by the Internal Revenue Service to report that income against that particular individual's Social Security for the calendar year. Now, this gets a little sticky when you're doing gift cards, because technically if they're an employee and you're providing them some type of fringe benefit, you want to take the deduction as a operating cost, and you want to stay away from having to impact the employee. So the gift card, as long as you're notating it and you're documenting what it was for and you're treating it as a gift, that can be deducted without impacting the employee. The unfortunate thing is that gifts from the IRS code are treated as not 100% deductible. So if you're treating this as a gift to the employee, then you're subject to certain rulings within the IRS. So I would recommend that if you're doing gift cards, that you try to stay away from the gift card aspect and maybe write them a check for, just a holiday gift versus a gift card. There's some sticky rules with that. And, by all means, we can talk about that in detail. You will get my email and my office phone number, and I can help you with that. So, Mary, let's go through the rest of your question here. I think this is the same person. What if you want to repeat?
Sure. Okay, so the next question is, what if I pay a certain amount? Okay. What if I pay a certain amount to the employee to help them with insurance? I have less than 5 employees. The employee gets, let's say, $200 a month. They use it for health expenses, but they will not enroll in insurance because they say they cannot afford it. Can I still get a credit for trying to help the employee?
Okay, you won't get a tax credit. That is for sure. So you can get the deduction. So I don't know, Mary, how your entity is structured, whether you're an S Corp, C Corp, sole proprietor. So that will depend, as far as the deduction goes, on how you will treat that $200. But you will not, I think, if you remember in the slides that we just went over, there are certain requirements that have to be met for the tax credit. Unfortunately, you will not get a tax credit because you're not meeting the reasonable type of requirements that the IRS has in store, or in the IRS code for this tax credit. You will get an operating expense deduction. So maybe this is a non-taxable benefit for the employee. So you will get the deduction. You just have to make sure that either in your minutes, bylaws, again, I don't know what type of entity structure you have, that it's stated there and it's a non-discriminatory expense, so that you're meeting the IRS guidelines so that you can take that deduction as a general operating expense, and that the employee isn't subject to tax related to that $200 per month. So in most cases, you should be fine. Again, I only suggest that you review what is required by you based on the type of entity structure that you have in place, whether it be an S Corp, C Corp, limited partnership, or a sole proprietor. But you should be fine with taking that as a standard operating deduction. Okay? I think, let's see. Oh, Steve has another question. Let's see.
Okay, another question is, if I wanted to meet with Paragon to explore whether we can be more strategic with our tax planning, should we meet as soon as possible or wait until after the tax season and use 2014 taxes as prepared by current CPA as starting point of analysis?
Well, Steve, that's a great question. my first question would be, why would you want to change accounting firms? You know, if you're feeling as though your current CPA isn't providing you enough analysis, then I would suggest, and you know, maybe they aren't, you know, providing you the strategic planning that you're looking for, then I might suggest that you switch right away, because, you know, maybe you might be losing out even in the 2014 tax year. If you're feeling like maybe it would just be nice for another set of eyes to look over what your current CPA is doing, we're happy to help do that. And in that case, I would recommend doing it after they've filed the 2014 corporate return, and then meeting with us and just having us look it over and maybe making a recommendation. It could be that they're doing everything that they can for you, and it could be that possibly they're kind of missing a few things, and we're happy to review that and look it over. So either way it goes, we're here and we're happy to help. So you will get our information at the end of this, and feel free to reach out.
Another question that's come through is there a limit to the amount for the gift check?
Well, Mary, definitely you want to, okay, so I just want to make sure that we're talking, when we say gift check, we're talking about maybe a bonus of some sort for your employees. Maybe you can answer that first before I continue on.
She's an S Corp, and yes,
yes, bonus. Okay, definitely stay under the $600. I'd personally recommend, if you can, run it all through payroll. I understand, you know, it's nice to get 100% of that up front, but you want to try to run it all through payroll, and maybe you talk to your payroll company and determine, you know, how to get them to that net paycheck so that they can have whatever dollar amount you're looking for. But yes, if you were going to go ahead and just cut the employees a maybe year-end bonus, you're definitely going to need to stay under that $600 mark, unless you're going to 1099 them, and then you would need to increase that. Okay. Let's see. Well, thank you, Mary. I really appreciate that. And again, thank you for the thank you. If you need anything else, again, our information will be provided at the end of this. Do we have any other questions here?
It doesn't look like we have any other questions, but plenty of thank yous have come across to Erica. We want to thank all of our participants for participating in today's webinar, and we will have Erica's information here at the beginning of our presentation. If you'd like to contact Erica, her phone number is 619-358-9799, and her email is erica@paragonaccountants.com. And we will send a copy of the slides to everyone who participated today, and you will receive that tomorrow. A copy of the recorded presentation will also be available on our Physician Resource Center website, and that will be available in about